Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Good day, everyone. Welcome to another financial podcast. Today, we're going to be discussing the economics of life insurance. Life insurance has been one of the most misunderstood products in the history of the world. I know in the history of the United States for sure. So today, we're going to talk about the different types of life insurance that are available in the marketplace, the importance of life insurance in economic development, whether we're talking about retirement planning or death benefit or family protection or whatever it may be. And we're going to be talking about some of the features and benefits that makes insurance such an incredible and viable contract to own in any type of portfolio of investments, retirement or protection from a business perspective. Now, first, I'd like to talk a little bit about the different types of life insurance that's available that are available in the marketplace. First and foremost, the probability of death is 100%. You know, we as Americans have a tendency to insure just about everything that we own, whether it's our homes, our cars, other properties that we may own, jewelry, etc. And we normally insure those assets for their replacement value. In other words, if I'm going to insure my home, I want to make certain that if my home burns down, that I'm going to receive 100% replacement capability on that property, because I would not be comfortable with receiving 70% or 50% or 20% or whatever it may be. Now, for insurance purposes, most Americans think of it from a different point of view. Now, obviously, we're not going to have the time today, although we will be doing a number of podcasts relating to insurance and its uses and the economic availability of these products for successful retirement or planning purposes or business enterprises and so forth. But we are going to be discussing some of the things that we feel are very critical for most of us to understand in this podcast. Now, primarily life insurance is divided into term insurance and permanent insurance. Under the concept of term insurance, the person who's purchasing a term insurance policy is primarily purchasing death insurance. In other words, someone buys a policy, 20-year level term, and the idea is that if they do happen to die within those 20 years, then the death benefit proceeds are going to be utilized in order to provide a benefit to someone. Now, term insurance can be purchased in many different ways. You can buy 5-year level term, 10 years, 15 years, 20 years, 25, 30 years. And what level term insurance means is that you're going to pay the same amount of premium on day one after the purchase of the contract to the last day of the viability of that contract. Now, term insurance also has something that is called annual renewable term, which means that every year as you get older, you're going to be paying a little bit more every single year, as opposed to a level term where you're going to be paying the same from the very beginning to the end. Now, I would argue that in an annual renewable term life insurance policy, you're going to be paying less in the very beginning. So if we're doing a 20-year level term and we're going to compare that to an annual renewable term, or ART as we call it in the industry, then more than likely for the first 10 years of the ART contract, you're going to be paying less than you would for the first 10 years of a level term insurance policy of 20 years. Now in year 11, there's a high probability that the annual renewable term is going to be higher in premium than a 20-year level term, and that's how it works. Now you also have contracts that you can purchase along those lines from a term perspective, but primarily the one that most clients purchase, at least in my company, is level term insurance. Now, the other thing that we need to understand is that there are risks associated with any type of insurance program. One of the major risks for term insurance is the fact that you're buying a policy for a number of years, and at the end of that year, if you don't die, obviously the contract is going to lapse, but you also may have the ability to renew that contract, but then obviously the premium will be a lot higher than you paid for the first 20 years of the policy. Now, one of the arguments that I have and discussions that I have with my clients is as follows. What is better, a term insurance policy or a permanent insurance? And the answer is it depends. At the end of the day, the best life insurance policy that you can purchase is the one that happens to be in place the day someone dies. And that's something that is important to understand. If I purchase a term insurance policy for $1 million and I die in year 15, my family is going to receive a benefit, or they're going to receive an economic value for the value of my life, because each and every one of us has an economic value. Now, if I happen to die in year 21 and I purchase a 20-year level term policy, then my family is not going to receive a benefit. So in those 20 years, not only did I lose the premium that I paid into that contract, because had I known that I was going to live past 20 years, I would have never purchased a 20-year level term policy. I would have purchased something else. So that means that if I bought that contract, not only did I lose the premium, but also I lost the opportunity cost of that premium. In other words, if I did not invest those premium dollars to cover that term insurance policy for a premium of 20 years, I could have invested that money somewhere else, earned an interest, and maximized my return. So therefore, if I don't die within the first 20 years of that contract and I lose that contract, not only did I lose that premium like you would in an auto policy if you don't have an accident at the end of the year, but I also lost the opportunity of what I could have done with that money had I kept it and or invested for a 20-year period. On top of that, I also lost the death benefit. My family lost the death benefit because that $1 million that would have been otherwise paid out, it was not paid out. So term insurance serves a purpose in the marketplace. I normally recommend to my clients that they purchase term insurance and then put a plan in place in order to convert that term insurance product to a permanent product within the first 5 years. And the reason for that is that since the probability of death is 100%, you need to be able to insure against that. Now, permanent insurance is a little bit more complicated because permanent insurance not only provides a death benefit, but it also provides a cash value or savings account growth inside of those contracts that would be beneficial for a number of different things. For instance, permanent life insurance provides living benefits that can be used while the insured person is alive. It can provide retirement benefits, we will discuss in a few minutes. It will definitely provide death benefit, which is very critical for the contract. It also gives the insured and or family members a permission slip meaning that you can do a number of other things with your existing assets just because of the fact of the leverage that you have of having life insurance in a portfolio. And then last but not least, it also provides estate planning benefits. Now, one of the most critical things to understand when we start to price and identify what the internal rate of return on an insurance contract is that insurance contracts have an internal rate of return, they have an external rate of return, and they have an eternal rate of return. What do I mean by that? Well, the internal rate of return is the rate of return that the cash value will build up over years based on contributions and so forth. Now, the more contributions you make to a permanent product, the better is going to produce for you, and the higher the rate of return. Now, under insurance laws and under the IRS code, life insurance is one of the most beneficial tax products that you can purchase in the marketplace. Now, because of the tax benefits of life insurance, the IRS, when it comes to permanent life insurance, does limit the amount of contributions that you can put in such a contract like they would to a qualified plan, an IRA, a 401k, a Roth IRA, and or other pension benefits. So there's a reason behind that. But permanent life insurance can be divided into four major areas. You have primarily universal life, which is interest sensitive as a permanent product. It has to be funded properly, and also you have to make certain that the interest rate that is being accredited is an interest rate that is fairly close to whatever the illustration numbers were at the time of sale. Then you also have what is known as one of the latest products in the marketplace, which is an index universal life. An index universal life uses a composite of a stock market look-alike portfolio. In other words, people have a tendency to think that when they invest in an index universal life, they're actually investing their money in the stock market. And the answer is no. The money is invested into the general account of the insurance company, and the credit that is and the interest that is credited to the insured on that account, on the cash value side of the account, is dependent on what some composite of the stock market may do from a business perspective from one year to the next. Now, one of the good things about Index Universal Life is that the cash value is protected because of the fact that the account is invested in the general account of the insurance company. And then even if the market drops 10, 15, 20% on a given year, the cash value does not drop at all. The worst that you can do in an index product is zero. Yes, you may not earn an interest for that given year or 2 or 3 years if the market drops consecutively, but obviously you're not going to lose any money in that cash value. Now the cash value may go down, but that would be based on the fees and other charges that are taken from the account by the insurance company, either on a daily basis, on a quarterly basis, or on a yearly basis. The next permanent product is what is known as variable universal life. Now, variable universal life has been around perhaps 30, 35 years, and VUL, as we call it, is a product that is primarily stock market sensitive, which means the money that client deposits into that account, the premium payments, after they take all of the cost of insurance and fees and mortality costs, and they invest the rest, the client gets to choose where those investments are going to be made. Most insurance companies will have different types of portfolios, from very conservative to very aggressive, but obviously if the market drops 10, 15%, 20%, as in the example with Index Universal Life, in the variable universal life scenario, the account value will actually go down because of the fact that there's no protection or safety net or floor in most variable universal life contracts. Now, whole life is the last that I will talk about, and in whole life, everything is guaranteed. The cash values are guaranteed. The death benefit is guaranteed. The premiums are guaranteed not to increase. With index universal life and variable universal life, the premiums are not guaranteed, because if you're not earning a given rate of return on an index because the product has been, or the investments have been losing money, or same as in the variable universal life product, you may be forced to increase your premium payments in order to keep the policy in force. Now, there's one area in whole life that is not guaranteed, and those are the dividends. Because the dividends are based on the profitability of the insurance company at the end of the year. Once they take the mortality cost, how many people died during the year, how much death benefit was paid to the decedents or the owners of those contracts at time of death. The mortality costs are going to be deducted. Also the expenses to run, the corporation and to run the policies will be deducted. And then obviously they're going to figure out what the internal rate of return was on the investments that were made using those products. Now, primarily whole life is very conservative. They invest in bonds, they invest a certain percentage in real estate, and so forth. And if there's any money left at the end of the year, then they will pay that as a dividend. Normally, dividends under insurance contracts are not guaranteed, although we work with insurance companies that have been paying dividends every single year for the past 100 years. But at the end of the day, they're not guaranteed, and we cannot tell clients or product owners of whole life contracts that although companies have been paying dividends for many, many years, their dividends are guaranteed, because they are not. Now, when it comes to insurance planning, whole life is the product of choice for guarantees. Every time you move away from whole life, whether you do it to the left with term insurance products or to the right with universal, index, or variable universal products, that shifting creates more and more liability to the insurance, to the insured owner, and is taking the liability away from the insurance company. In other words, in term insurance, well, one of the major liabilities is time. If you purchase a 10-year, 15-year, or 20-year level term, the policy may actually die before the insured does. So time is a risk and a liability that the insured and the policy owner needs to address and plan for. In universal life and in universal life and index universal life and variable universal life, there are a number of risks associated with the investment. Are the interest rates that the contracts are earning adequate in UL in order to meet the expectations of the clients for mortality? Are the clients going to be able, or are they going to be forced to add additional premium payments along those lines if they want that policy to be alive at the time that they die? We do a tremendous amount of insurance appraisals and insurance audits, and whenever we do that, we identify what are the issues and concerns for each and every one of those contracts, and making sure that we also educate our clients as to where they are from an economic standpoint and the productivity of those insurance contracts. Variable universal life has a number of risks associated with it. Obviously, the insured has to be fairly knowledgeable of investments. They have to identify the right investment, the right portfolio, the right combination of products. They have to keep an eye on the internal rate of return on those products as well. And they have to be able to have to make additional premium payments if the performance of those products are not apropos to when they were originally sold to the client by the given advisor. Whole life has none of that. All the insured person has to do is wake up, pay the premium every single year, and there's a guaranteed column that guarantees is a guarantee by the insurance company that if a given premium is paid, a given cash value will be accredited to the account on an annual basis, and the death benefit will guarantee. Now, if they do pay a dividend, that falls under the non-guaranteed side of the ledger, which will actually increase the cash value or accelerate the increase of cash value with the dividends, and will also accelerate the death benefit along those lines as well. So those are tremendous features. Now we're going to do other podcasts in which we're going to be spending time on each contract individually, but I just wanted to give you an overview of how they work. Now, what are some of the living benefits? There are many of them. I'm not going to cover all of them, but what I can tell you about living benefits of permanent life insurance is that number one, the cash values can be accessed via withdrawals or loans on a tax-favored basis. I have a lot of clients that are taking retirement distribution out of their whole life contracts, and they do it on a guaranteed basis, and they also do it on a tax-preferred, tax-free basis, which is non-reportable to the IRS. There's no income tax on the earnings of the contract from one year to the other. The contracts provide liquidity for emergencies and or other strategic needs. And by the way, these benefits apply for most permanent contracts. Obviously, based on some of the discussions that we have had regarding the interest rate and how they get accredited, or the stock market returns and how they're accredited, those are some of the difference between the permanent contracts. But some of the features are pretty much the same. Now, when it comes to a whole life contract, the yield is an above average yield compared to other fixed income instruments. Now you have to remember that whenever you do a comparison between an insurance contract and a stock market or a mutual fund or a bond or an index, you have to be able to compare apples to apples, and that's what we do at Cambridge from an economics standpoint. Now, for those of you that reside in the state of Florida, life insurance contracts, all of them offer credit protection in this state, and they do offer credit protection in certain other states as well. There are many flexible policy contract features which are very, very important. Contributions, premium payments can be flexible many times. There are people that feel that whole life contracts do not have a tremendous amount of flexibility, and that's because they don't understand how whole life contracts work. But the good thing about permanent products, whether we're talking about UL index, VUL, or whole life, is that they do have certain flexibility and benefits associated with them. There are no maximum contributions as in qualified plans, except that there are certain insurability limits. In other words, the IRS basically says that for the first 7 years in a permanent life insurance contract, you can put from a given dollar based on whatever the target premium may be. So for instance, an example could be that someone purchasing $1 million of permanent life insurance would have premiums of, let's say, $8,000 a year. That would be the minimum premium payment, and the maximum could be $23,500. So the insured has the ability to put money in those contracts between the $8,000 and $23,500 for the first 7 years without creating any tax liability. Another great feature that these contracts allow is it's a catch-up provision, similar to the one that you would have in a qualified plan when you get to age 50, but here there's no age limitation. What do we mean by that? Well, let's say that you start putting $8,000 a year for the first 2 years, and then your business starts to do real well, or your income increases significantly, and in the third year, you want to maximize the contributions to the contract and put in $23,500. Well, you not only have the ability to put in the $23,500 for that year, but you also have the ability to go back to the previous year and the year before that and add the difference between what you had already contributed which was $8,000 up to the maximum of $23,500 for each of those 2 years that you failed to contribute to the max. So it does give you the ability to catch up and to truly put extra premium that will assist tremendously in the performance of those vehicles. Another benefit of permanent life insurance is that contributions are systematic, and they do create a committed savings plan or a committed savings habit. Now, obviously, along those lines, in an insurance contract, whether it's term insurance or permanent insurance, you can add different riders that will enhance the benefit and performance of those contracts. For instance, you can add disability premium waiver. So that means if someone becomes disabled and they're still disabled after 6 months, if you have that rider, you're going to be able to have the insurance company pay those premiums on your behalf for as long as you are disabled. You also have the ability to add one of the most important riders in the type of insurance planning and economic models that we do for our clients, and those are critical illnesses or long-term care riders that will allow the insured person to be able to take money out of the death benefit without having to die, as long as they have a qualifying illness that is guaranteed by the insurance riders for long-term care benefits. So, and all this happens on a tax-preferred basis. And it's very, very good, because if you purchase a traditional long-term care policy today, the big question for you is, how are you going to die? Now, the thing about long-term care is that the probabilities are either 0% or 100%. No one is anywhere in between. Either you die in your sleep, never having a need for long-term care services, or you're going to have a need for long-term care services. And then the question is, at what level are you going to need those services, and how will you pay for those benefits? Now, those are just a few of the living benefits. When it comes to retirement benefits, which is something that we specialize here at Cambridge in, is that distributions at retirement can be tax favored if you structure it properly. Now, there are no required minimum distributions at age 70 and a half. One of the two best features in retirement distribution planning is the fact that it's not like a traditional qualified plan. In traditional qualified plans, you cannot take withdrawals from the plan unless there's exigent circumstances or certain distribution techniques prior to age 59 and a half. Why? Because if you do so, you're going to have to pay a 10% penalty to the IRS if you have money in an IRA or a 401k or any other type of defined benefit plan. Now, obviously, you can borrow money if the document allows it, but if you borrow that money, you must pay that money back, and you have to do it with after-tax dollars, and you must do it for a maximum of 5 years. So there are a lot of handcuffs that are applied to individuals that invest in qualified plans that do not apply for life insurance. So life insurance contracts do not have the 59.5 rule, and they don't have the 70.5 rule. As most of you may know, if you own a qualified plan, IRA, 401k, pension, or whatever it may be, you must start taking distributions at the age of 70.5. If you don't do so, then not only will you have to pay taxes on the distribution that you failed to pay, but there's also a 50% penalty that will be assessed to the amount of money that you should have taken at age 70.5 and years of thereafter, which you didn't take. So in reality, in most qualified plans, you only have an 11-year window in which you have all the flexibility that you're looking for. And that would be between the ages of 59.5 and 70.5. None of that happens in life insurance contracts, and that is why owning a life insurance portfolio as part of your entire asset portfolio, it's a critical aspect of economic modeling and economic planning. Now, you can also create lifetime income stream, and they provide various distribution options that we're not going to get into. There's no annual tax return filing for any of these contracts. They're not subject to the IRS regulations like ERISA, DEFRA, TEFRA, OPRA. We don't have the time to talk about any of those here. They're not subject to compliance penalties or fines or in qualified plans. There are no termination requirements or obstructions. They're simple to initiate. If a client wants to start an insurance program for retirement purposes, they don't need attorneys, CPAs, and they don't have to have any type of government approval. So the flexibility is enormous when it comes to that. Many of these contracts that we handle at Cambridge, we do for our business clients because they're interested in providing executive benefits to key employees in their corporation, and there's no better product than permanent life insurance in order to do so, which is something very, very critical. Now, the death benefit that you see and that is associated with these contracts are similar whether you're on the term side of the house or the permanent side of the house. Obviously, proceeds are received in cash by all beneficiaries, including trusts. The proceeds are received free from federal income taxes, and if properly structured, free from federal estate taxes. Now, obviously, in order for you to be taxed on federal estate taxes, if you're married, you have to have an estate that is worth a lot of money, closer to $12 million based on today's rates. If it's lower than that, then even if you owned the life insurance contract on your life personally and it was not in a trust, then your family will receive it free from federal income taxes and free from state taxes. Many of my clients use the death benefit proceeds of these insurance contracts as a full expression of love and concern to family, businesses, and designated charities. Life insurance is a product of love. It's a social product, and that is why under the IRS code, it enjoys so many more benefits compared to any other product that is sold in this country. And the reason is simple. It is a social product from a business perspective. Now, the other thing that the insured person can do is that he or she can create or make certain that the proceeds can be received as a lifetime annuity income to the survivor. So, for instance, if you have a married couple and the surviving spouse is not very savvy when it comes to money management, the insured can set it up in such a way that instead of just sending an entire lump sum to that surviving spouse, for him or her now to manage. Now they can make it on a piecemeal basis, and the insurance company will be sending an annual distribution to maintain that standard of living for many years to come. Sometimes you can do a combination of both. You can pay out an immediate death benefit up to a certain percentage. Let's say you want to pay out 50%, and then the remaining 50% will be paid out as an annuity on an annual basis for life or for a given number of years. Now, the death benefit side of the contract also provides for payoff of personal and business debt. And those are things that are very critical for many of the clients that I deal with. Many a times a death benefit provides cash in order to keep a business afloat until a suitable buyer is acquired or purchases the company. Proceeds are also used to replenish the money that has been spent on medical expenses and or nursing care. Another big benefit that I use quite a bit for some of my clients that have children that have special needs. One of the interesting things about special needs is that the liability doesn't stop at the point in time that the client dies or the insured dies. The liability will only stop at the point in time that the special needs child dies. So we do specialty trust using life insurance to provide guaranteed assets for special needs children and or adults. Obviously, death benefit proceeds can also increase, as I stated earlier, with the different dividend options that are provided in these life insurance contracts. Now, if you recall, I said that life insurance has three different types of rates of returns. So it has the internal rate of return that you can find depending on how well you do in managing your contract. You have the external rate of return, which is the rate of return that you can obtain on other assets in your portfolio just because of the fact that you have life insurance as the core benefit in your asset and contracts. And what are some of these things that can be done from a business perspective? For instance, the permission slip is one that we use with many of our clients as we start to plan for retirement income. Number one, pension maximization strategies that increase guaranteed retirement income for life. So if you work for a governmental entity or you work for a private company that provides a pension benefit, they're going to give you different options as to how you're going to take your pension benefits. Most people are going to take a survivor benefit, so they're actually buying life insurance inside of the pension system. Well, if you have your own life insurance contract and it's permanent in nature and not term, you do have the ability to increase your retirement distribution by choosing that distribution option that gives you the highest benefit while you're alive, because at time of death, the death benefit proceeds from the life insurance contract will replenish that pension benefit that was lost because of the fact that the benefit died at the same time that you as a client did. It also increases the spousal protection on a guaranteed basis. Many a times is not enough. So by having an insurance contract in place, you're able to increase that spousal protection at the time of death. Now you can also use it to pay down of assets while increasing distribution rates. So for instance, if I have $1 million in a mutual fund portfolio, and we already covered this in another podcast, so this is very briefly, if you have $1 million in a mutual fund portfolio, and you want to accelerate the distribution by paying down interest and principal out of that portfolio over a 20, 25, or 30-year period, you can do so. Why? Because since you own permanent life insurance, you don't have to worry about not having enough money if you live long enough to provide a survivor benefit. Because of the fact that regardless of how much money you and your spouse used while you were in retirement, at the time that one of you passes on, the death benefit proceed that is paid by the insurance company to the surviving spouse on a tax-free or tax-preferred basis will now replace that income that was utilized as capital distribution during those retirement years. Another use in permission slip for these contracts is for reverse mortgages, and this is something that is happening quite a bit now in the United States. You have the ability to do reverse mortgages, and the death benefit proceeds will give you the ability to buy back that property and pay off the loan at time of death. Insurance contracts can also be used as collateral for private loans and or business loans, and we do that at Cambridge for many of my clients that are business owners regularly. Business loan capabilities that you can use to increase the internal, external, and eternal rates of return. The eternal rate of return is the death benefit that is paid out at the time that the insured dies, which is an enormous rate of return from a business perspective as well. But also remember that the cash value inside these contracts is very liquid. You can use it at any time. You can borrow. You can withdraw up to the basis, meaning the amount of contributions that you make. And then at the point in time that you're going to start dipping into the growth of that money that has not paid any taxes, you do have the ability to convert to loans and continue to take withdrawal without having to have any tax liability. For estate planning purposes, obviously the assets can be assigned to a trust, whether it's a revocable trust or an irrevocable trust. So a lot of things can be done along those lines that are fully eligible for the marital deduction. It's not subject to probate, meaning that death benefit proceeds do not have to go through probate. There's no publicity at death. And increases the growth of the estate on a tax-preferred basis. Not only that, the proceeds can also be used to pay taxes on large IRA and or qualified plan distributions. And it enhances the stretch IRA options at death for many clients. Now, in summary, insurance contracts, if you understand them well, have a tremendous benefit that is critical from a business perspective. So at the end of the day, and what I say at the end of each and every podcast is that our job is to assist our clients in changing the way they see things. Because when they do change the way they see things, the things they see change. Now, we're going to be doing more of these on all areas of insurance contracts, whether it's understanding homeowners, auto insurance, disability insurance, long-term care. We will revisit some of these issues of life insurance, but I'm hoping that you have really enjoyed this today, and I want to thank you all for attending, and we'll talk soon in our next Cambridge Financial